The Federal Reserve has hiked its benchmark interest rate by 0.75%. But what does that actually mean for hundreds of millions of Americans who have jobs, who buy things, who have bank accounts? In short, interest rates are the Federal Reserve's main tool to combat inflation. Inflation is driven by strong consumer demand. By raising interest rates, which makes things more expensive, the Fed is hoping to dampen Americans' willingness to spend money. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all, said Federal Reserve Chairman Jerome. And the Fed will continue to raise rates as needed throughout the year if inflation doesn't abate, Powell said. Its next meeting will be in late July. The Federal Reserve got inflation wrong. And now they're trying to correct their mistake by pretty quickly hiking interest rates. And that will slow the economy, said Aaron Klein, a senior fellow at the Brookings Institution, in an interview with NPR. Generally speaking, as the Federal Reserve raises its benchmark interest rate, everything else in the economy that involves interest rates of some kind is affected, and that's most things: credit cards, student loans, home and car loans, banking, savings accounts, the everyday operations of business. That means the stakes are high when the Fed raises rates, as it did on Wednesday. With inflation being as high as it is and seeing some softness in the U.S. economy, the Fed really has a very delicate balancing act this month and for the next couple of months, said Dave Sekera, the chief U.S. M. The Fed's interest rate isn't directly tied to mortgage rates. But mortgage lenders move their rates up and down based in part on what they expect the Fed to do. With inflation so bad right now, mortgage rates have been rising all spring. Today, the average 30-year rate is well above 6%, according to Mortgage News Daily. Earlier this year, a 30-year fixed-rate mortgage could be had for around 3.25%. Given a loan of $400,000, the rise in interest rates has turned a monthly mortgage payment of about $1,700 into one approaching $2,500 in the span of just a few months. Housing is getting less affordable for everyone at every level, said Daryl Fairweather, chief economist at Redfin. That rapid increase in cost has already priced some potential homebuyers out of the market. Mortgage applications for home purchases in June were down more than 15% compared to last year, according to the Mortgage Bankers Association. Mortgage rates have historically been higher, especially in the 1980s, when rates topped 15% amid the Fed's efforts to fight the inflation of the 1970s.